Hello and welcome to our Albertson Company's managerial analysis. My name is Mallory Marino.
Teresa Marine.
And I'm Philip Parfait.
To begin, this report provides an overview of Albertson Company's financial position within the food retail industry and an analysis of risk and trends that could affect our overall performance. This report covers data taken from the 10K reports and the financial statements of the S&P Capital IQ website. The objective is to capture specific behaviors, discuss the risks involved, and provide alternative solutions to better our financial position. We will discuss how temporarily halting acquisitions and building new stores will lessen our overwhelm indebtedness, which will create positive cash flow and increase equity for the Albertson companies.
The Albertsons company spent about $1,630 million in the capital expenditure during 2020. They opened 9 brand new stores, renovated and modernized 409 stores, and acquired 27 buildings controlled by King Food Market and Balducci Food Lovers Market. The cash flow from the sale of land, building, and equipment was $161.60 million. The proceeds from the sale of assets was $161.6 million in the fiscal period of 2020, were counterbalanced by the payments for property and equipment of $1,643.2 million, and the Kings and Balducci acquisitions of $97.9 million. The payments in property of equipment include the store's opening, remodeling, the acquisition of mentioned, plus investments in continuing digital technology. The overall net cash used for the fiscal period was $1,567 million. The proceeds from the sales of assets were $1,096.7 million in 2019, were counterbalanced by the payment of property and equipment of $1,467.4 million. Payments of property and equipment included the 14 stores opening, 243 remodeling, plus investment in continued digital technology. Proceeds from the sales of assets mainly involved the sales and leasebacks of 53 store properties and 1 distribution center for $931.3 million, net of closing costs during the second quarter of the fiscal 2019. The overall net cash used for the fiscal period was $378.5 million. For the past 3 fiscal periods, the proceeds of sales and assets compensated for the spending of property and equipment. In the fiscal period of 2021, we plan to spend between $1.9 billion to $2 billion on capital expenditures. So we'll need about $5,750 million to $4,750 million to $5,250 million to satisfy our liquidity needs during the next fiscal period. This includes expected needs for working capital, capital expenditures, interest payment, scheduled principal payments on debt, dividends of Class A common stock, dividends on convertible preferred stocks, operating leases, and financial leases. The hope that the cash flow from current operations and other liquidity sources will be sufficient to satisfy our liquidity needs includes borrowing under the ABL facility for at least 12 months. Currently, there's enough cash flow maintaining our existing debt scores, which aids in overcoming competitive conditions. Furthermore, we will try to refinance some of our debt as well. However, there's no guarantee our business will continue to produce existing amount of cash flow that can retain our ability to borrow under the ABL facility. At regular intervals, intervals, signs of impairment are reviewed, compared to individual stores' operation performance, accompanied with current market conditions. When conditions demonstrate an innovative individual store's carrying value may not be recoverable, future discounted cash flows are evaluated against the carrying value. Impairment loss are recorded at the carrying value of stores' assets being held and use are greater than the future discounted cash flow of fair value. For property and equipment held for sales, impairment change are recognized for the surplus of carrying value. The additions to estimate cash for the disposal over the fair value. Fair values are based on discounted cash flows or current market rates. Fair value estimated can be significantly impacted by the circumstance such as existing economic environment change and real estate market conditions. Long-lived assets impairment loss were $30.2 million of 2020, $77.4 million in 2019, $36.3 million in 2018.
Depreciation is recorded on a straight line basis, and property and equipment are recorded at historical cost or fair market value. Estimated useful life of buildings are recorded between 7 to 40 years. Leasehold improvements are recorded at the shorter of the remaining lease term or between 10 to 20 years. Fixtures and equipment are recorded between 3 to 20 years, and specialized supply and sheet equipment are recorded between 6 to 25 years. Depreciation expenses were $1,297 million in 2020, $1,244.7 million in 2019, and $1,257.7 million in 2018. Amortization expenses related to finance lease assets were $67.4 million in 2020, $90.2 million in 2019, and $101.4 million in 2018. Fixed asset impairment losses of $8 million in 2020, $21.8 million in 2019, and $31 in 2018 were recorded as a gain on property dispositions and impairment losses, net in the past 3 fiscal years. The impairment losses are correlated to assets and underperforming stores. Certain excess properties in 2019 included certain leasehold interest, also equipment related to plated meal kit subscriptions and our delivery business. In 2021, we acquired 27 stores from King's Food Markets and Balducci's Food Lovers Market for $98.1 million. The transaction was recorded using the acquisition method of accounting, which was allocated to the fair values of the recognizable assets and liabilities. Acquired assets mainly consisted of fixed assets valued at $41 million, intangibles valued at $31.6 million, and inventory valued at $18.1 million. The acquired intangible asset was the trade name. The total assets acquired was $102 million. Also, we purchased $3.9 million of net assets at a bargain price, and it was recorded as a gain within selling and administrative expenses for year 2020. This was possible due to King and Balducci's bankruptcy. Our capital allocation strategy stabilizes future investments, enhances the balance sheet, and improves returns to shareholders due to blends of dividends and resourceful share repurchases. We analyzed the trends to capital expenditures to net sales. In 2020, that ratio for capital expenditures to net sales was 2.34%. In 2019, it was 2.36%. And in 2018, it was 2.25%. We also analyzed the trend of net plant assets to total assets ratio. In 2020, that ratio was 19.08%. In 2019, it was 23.91%, and in 2018, it was 24.79%. As you can see on the table, the capital expenditures to net sales was at an upward trend. However, the net plant assets to total assets was on a downward trend. In conclusion, the capital expenditure gains had an upward trend for the past 3 fiscal years, but the increases were minor compared to net sales, making the positive gain vision immaterial. Net plant assets trended downward in the past 3 years. As total assets increased, net plant assets decreased, which is indicative of continued losses in value for our buildings. These behaviors indicate we have earned gains on their acquisitions, but are losing value on buildings compared to net sales. Our indebtedness will exacerbate these losses of value for future acquisitions, which could force us to liquidate.
So for the risks of our company's indebtedness, our significant amount of debt has placed us in a position that could lower our ability to generate cash. Our debt instruments can limit our flexibility in business operations, increase interest rates, and reduce our credit ratings, and also create liabilities under particular operation leases that were designed for third parties. For the industry, the intensity of competition in the food retail industry causes risks to our ability to appropriately identify or react to consumer trends. Also, our consolidation in the healthcare industry is a substantial risk to growth, along with the limited insurance coverage to protect us against potential claims. For business and operations, numerous operating factors and economic conditions affect our industry, which can negatively impact our business and operating outcomes. Also, the 2019 COVID pandemic continues to impact prices and availability of energy and fuel to manufacture, stores, transport, and sell products. For the supply chain, natural disaster and severe storms disrupt product supply, notably those who are perishable products. Also, security threats regarding foods and drug safety, along with continued widespread pandemics, has created a loss of confidence in the supply chain. The constant risk in fuel and product prices put a strain on operation as well. For the legal and regulatory, changes in government, environmental regulation, and tax codes have created disadvantages to our business. Lawsuits and other legal proceedings also have substantially affected, creating issues with our use of insurance to protect us against potential liabilities. In the common stock, the price of our stock has a risk of declining regardless of our performance in operation. Being controlled by sponsors is also a risk because of the conflict of interest with other stockholders. Also, being a controlled company in the New York Stock Exchange has an essential effect on our stock prices. Furthermore, the conditions of our charter documents prevent us from changes of control, not to mention our stockholders' ability to receive beneficial judicial opportunities for disputes with our directors, officers, and other employees are very limited. There's also a risk of not being able to pay dividends to our stockholders for common stock and preferred stock affecting market prices because of the limited rights common stockholders possess. In the workforce, the risk of our workforce are related to labor disputes, work stoppages, continued relationships with labor unions, and risk pension costs, payments, and fees. Also, growing wages and failure to hold on to experienced workers and essential personnel are risks to our workforce. For our future initiatives, another great risk to our company is the inability to acquire properties on adequate terms. This is mainly in part of our indebtedness. Also, we may not realize expected benefits from our productive initiatives in a timely manner. And in conclusion, by temporarily discontinuing accusations, we can save millions of dollars because the proceeds from sales of assets will not offset the spending on property and equipment related to accusations. Additionally, our liquidity needs will be further met without excessive borrowing. This will lower our indebtedness, resulting in increased equity. And upgrades in workforce and operations, proceeds can be used to continue upgrades of currently used owned stores. Quality and property working stores help maintain the morale of workers and managers, which improves workforce and operations. Furthermore, by possessing a competitive wage, we can better retain skilled workers, enhancing our competition with other food retailers. Also, some of these savings can be used to offset rising supply chain costs, which will improve operation efficiency.
And that is the end of our presentation. Thank you very much for your time. Have a great day.